Hey guys, I'm Dave Keller, the Chief Market Strategist at StockCharts.com, based out of Redmond, Washington. Happy to be here at Real Vision in New York, sharing sort of my overall take on the markets. And what I wanted to do was share a particularly painful moment in my investing history, because I think one of the best things you can do as an investor is learn from other investors' mistakes and their challenges. So I want to talk about the 2013 top that I found very difficult as an analyst to manage. I want to look at how today's market, I think, has similarities, but also some differences to that 2013 top. Talk about an overall long-term bullish thesis leading into the seasonally strongest part of the 12-month period, but some of the causes for concern in the short term. Hope to wrap all that up with three charts that I want to leave you with. So getting to the charts here, the first one I'll look at is a long-term view of the S&P 500. And this is essentially my career history here. I actually started in June of 2000, which is the middle right here, right after the March 2000 peak. So when I entered the industry, it was all about how easy this was and how the markets keeps ripping and it's long and strong. Don't worry, it's easy. That, of course, ended immediately, and we had 9/11. We had the unpacking of the tech bubble into the 2002 low. And so the beginning of my investing career was actually very painful, and it dealt a lot more with fear than it did with greed. And so I think for me, it's dealt me to focus a lot on risk management and potential downside. So I felt like a rock star genius in 2007 to 2008 when I saw the market returning to the 2000 high, expecting resistance, expecting a rotation. We had all those things. We had the lower high at the beginning of 2008, which felt about right. And then we kind of went to new lows there. So then fast forward to 2013, which was right here. This was the third time we then repeated back to that S&P level, the same as the March 2000 peak and the 2000 peak. I felt like a genius rock star turning bearish here as well, because I saw the market become overbought. I saw a lot of stocks being overextended. I saw the levels approaching the level at which we've topped out before. And so I felt it was an appropriate time to turn negative. And I did, and that was wrong in a big way for a little while. And I think that on its own, it's okay to be wrong. It's not okay to stay wrong, and I think that was my biggest mistake. And so, for me, staying negative for about a 3 to 6 month period after that point, as the market continued to grind higher, as you saw stocks making new highs, you saw an increase in the new highs list, you saw an overbought condition that just remained overbought. All of those things should have told me that the bearish call was wrong and to turn positive, and I just didn't want to do it. And so finally kicking and streaming into the fall, I turned back positive, which ended up working out okay. So now fast forward to where we are now, looking at a daily chart of the S&P 500, and there are some similarities, right? We're now at all-time highs. We're now at continued new highs. So we've broken above resistance, which is one, potential difference between now and 2013 for sure. We're a little bit above the peaks, and again, being above the July and September peaks, I think was a huge vote of confidence for long-term strength in the equity market in the U.S. We have an overbought condition though, and for me, I'm seeing a lot of similarities now between what we saw over the summer. So looking back at the July period where we had new highs, we sort of rallied, had continued higher highs, higher lows. We had overbought conditions. That wasn't the warning signal. The warning signal is when we had that one final push higher and a lower RSI. I'd call that a bearish divergence. We've not seen that yet, but that's what I'm sort of expecting. I'm sort of expecting a little bit of a correction here, one final move up, and I wouldn't be surprised if we get some sort of divergence. Probably going into the new year would be my guess, and that's based on just the seasonal tendencies. But I'm going to vote on with the price and see where that heads. So overall, the similarities are an overbought condition, at our near new highs. And the concern or the potential issue is a bearish divergence. So that's what I'm on the look for. A lot of people have talked about breadth, and the next chart speaks to breadth and breadth strength in particular. A lot of people have talked about the challenges with this bull market is weaker breadth. And the problem is you have a strong tape, and small caps and mid caps haven't been participating as much. But if you look at the cumulative advanced decline lines on the S&P 500, so that's large and mega caps, you then have the mid cap index and you have the small cap index, all going to new highs. So even though, small caps have been lagging, they still are showing positive breadth, and by my take on it. So until you see a breakdown in those breadth lines, particularly small and mid caps, overall the trend remains fairly constructive. One of the other votes of confidence for an extended bull market is a breakdown in some of the defensive sectors, particularly utilities and real estate. And that's one of the things I've been watching. So you had this consistent uptrend in utilities paying a healthy dividend, sort of long and strong up and to the right. Then we have a breakdown through the 50-day moving average, a breakdown through support here at 63 for the XLU, and now lower lows, lower highs. And if that trend continues, I think that tells you further upside overall in more of the juice, more of the traditional offense. Now, one of the other ways thinking about sector rotation that I've been concerned about is looking at consumer discretionary versus consumer staples. So when this ratio on the top is going up, that means discretionary outperforming staples. That's more offense. When it goes down, that means staples are outperforming, more of a vote on the defensive side from institutions, essentially. This ratio has been in a downtrend since April to May. As we have lower highs, lower lows, we have not eclipsed a trend line using the highs in that ratio. So in my opinion, that feels more like people are leaning on the defensive side of consumer versus the offensive. But if you do it on an equal weighted basis, if you use the two equal weighted ETFs, you can see it's actually already broken out, already shown you that if you're thinking more equal weighted, which in my opinion speaks more to stock picking and the benefits of that, there are opportunities within the consumer space that might not be obvious if you're looking at the top level cap weighted indexes. So stock picking, I would be looking at consumer discretionary for some potential ideas. Now, in an extended market, one of the things I would look at is some of the largest bellwether names and see what they're doing. Apple, I think, encapsulates where we're at with this market. This has been up and to the right, long and strong, above 2 upward sloping moving averages. We like all of those things. It has become extremely overbought, or an RSI above 80. When it's overbought, an RSI above 70, you'd expect a bit of a pullback, but an RSI above 80 tells you the momentum is so strong. I've always called that a good overbought, meaning it's gone so strong, the momentum so positive. After a bit of a pullback, you'd expect further upside. That's why I think the chart of Apple lines up really well with that big picture thesis of a potential RSI divergence later, once you see the market try to move to new highs with less momentum behind it. There's plenty of momentum now. Now, a couple charts to pay attention to. These are the ones that I'm looking at just to measure how we perform into year end. And if you're not looking at these charts, I'd encourage you to make them part of your routine. Number one is looking at the VIX. I don't necessarily use volatility in the form of the VIX as a predictive measure, but I think it tells you a lot about historical trends. So the VIX bottomed out at 12 back here at the summer highs in July, also the highs in April. Both of those had a VIX around 12. We're right back at those levels. While that not necessarily tells me to be a screaming bear at this point, I like the fact that there's a rhythm to it. I like the fact that it rhymes with previous market tops, which is why I'd expect a bit of a pullback here. It sort of lines up with what we saw earlier. The next chart is maybe a potential area of concern. Something I'd be watching is the breadth within the S&P 500. So as the market has been pushing to higher highs, at the bottom panel here, we have the percent of S&P names above their 50-day moving average. So every time the S&P has returned back above its 50-day, has pushed higher, one more leg to higher highs, less and less individual stocks have been doing the same thing. So you have higher prices, but less companies going back above their 50-day. That speaks to an internal weakness that might not be as obvious from the broad chart of the S&P 500. And the third chart I would hope you pay attention to is the XLF. This is something that's eclipsed a 2-year base, which is pretty meaningful. You could call this an inverted head and shoulders type pattern, or certainly a complex basing pattern. For 2 years, the XLF has found resistance from around 28.25 to 28.75. It broke above that a couple weeks ago at the end of October, and now has eclipsed this previous high from the beginning of 2018 after the rally out of the December lows from last year. So as long as this remains above that 28.75 to 29 level, I think it's long and strong for the XLF, and I think that continues with relative performance being strong. And overall, that's what I would be looking for to tell me to continue to be on the long side of the market. So that is a painful lesson I had in 2013, not trusting the evidence around me, which is why now I'm paying especially good attention to all the evidence I'm seeing. Overall, I think entering the seasonally strongest part of the year, you have a lot of things telling you that the long-term trend is positive, but things like volatility and some of the other overextended charts like Apple suggest a little bit of a pullback that I'd be looking for in the next couple weeks for sure. So that's my take. I'm Dave Keller, Chief Market Strategist at stockcharts.com. Thanks a lot.